There they are. Hey, everybody. I hope you all are doing fantastic and having a beautiful Friday and maybe a beautiful week. Thank you for spending your Friday night with me. I know it's a lot to ask. And thank you, Heather, for spending your Friday night with me. Appreciate you all being here. I hope you find that you're getting some value out of this, a lot of value. We're 80% of the way through, but really, I think you get the gist of what we're doing here. We have the $10,000 dare. I think I showed you a few examples yesterday of how you can get there. And I tried to show lots of different size accounts and size trades. Obviously, the bigger the trade you have, the easier it's going to be to make your $10,000 challenge work and become a reality for you. So tonight, let's put it all together, tie it all together, put a nice little bow around it, and I'll show you a few things. We've got to stick to an hour tonight. But with that being said, let me quit being verbose and get right to it. We'll go now. Here, one second. Of course. Whoops. All right. I think I just closed the presentation. Hang on just a second. I guess I'm not very tech savvy. I thought it was really cool and tech savvy, but maybe I'm not. Hang on just a second. Okay, now we got it. All right. Can everybody see that screen
Not
yet,
yet.
or do I need to share it again?
Yeah, you didn't share anything. No, not yet.
Okay.
And now it's coming up, I think. Yeah. Nope. No, it's gone.
All righty. Sorry about that, everybody. Okay. Okay, so tonight we're putting it all together. The right stock in the right market at the right spot on the chart and the right option. And so we've gone through the nuances of that. And what I've tried to do the whole time is give you a framework. None of these rules are really set in stone, but I've tried to hone it down so that we're kind of going down the middle and you can operate if you want on the fringes. And even some of the worksheets I put together, like, hey, if you like return on equity over 20% instead of 17, that's great. I mean, I'm just telling you what I use and what I've seen hundreds of students in programs that we do use and have success with. But, you know, some people have success with stocks that are 10 bucks. It's just the probabilities are a little different, right? So I've been trying to give you like a structure because I want to keep the emotions out of your trading. But at the end of the day, you're going to need a trading plan with your own structure in it. Everybody's are different. But you know, you can pick and choose what you want to do. If you want to do all of it, great. It's just going to you're going to be kind of going crazy looking at all the rules. All right. Here's what we're going to cover today. The weekly decision making process, the live market analysis, which I do 3 or 4 times a week, but I post it on Friday for you if you happen to catch it today. You'll get a review of that. 3 real trading examples. Well, we're going to use those trading examples as a jumping off point, and I'm going to show you the stuff that I showed you last night with the different strategies: Fortress, Balance Point, Rocket. The weekly decision tree, so that you can take this away and you can have a weekly decision tree, and also like a planning sheet that you can know how little time it really takes. You can also spend a ton of time if you want. And then we'll wrap up the challenge and we'll talk about the next steps and things like that. And then right after this, we also have a VIP call. So that's why I have a hard stop at 8 o'clock, which means I won't be able to go on tonight with Q&A. So we have to stop at 8 so I can go on to the next call. So I have a hard stop, but that's okay. We're going to get to a lot of stuff, and I'm going to whiz through it because there's even going to be some slides that I'm going to skip, and you can always look at them later if you want, or I kind of cover them in a different format. So the 4-step system is the stock, the market, and the chart plus you add the option there on the end of it. So this is the complete decision-making process. We started Monday with the right stock. So now when you go to the cocktail party and people say, hey, Jim, what are you buying? You could tell them. You could say, here's the stock that I'm doing. Because if you tell them that you're doing covered calls, their eyes are going to glaze over and they're going to go get another tequila. So you're going to want to just talk about the stock, because when you start talking about selling calls to people that have not been trained in them, trust me, it's a tough sell. You're pushing a boulder up a hill. So we've got a scored watch list for the right stock that you can use. We talk about the right market. So we talk about the red, green, and yellow, and which appropriate strategy, like kind of goes down the middle. But, you can kind of be fuzzy on it, and you can go deeper in the money or a little bit less in the money or whatever you want to do. We talked a lot about the right spot on the chart. One of the things that I think is incredibly important is reading charts, and that's why I spent so much time. And hopefully you gained an appreciation for having that probability at the right spot. I think we saw a lot of charts that when they got to that right spot, they took off. Not all of them do. They test, but they do pretty well. And then finally, we spent some time yesterday really going over the options, which options to choose for your strategy, which strikes, how far out. We're going to do a little bit of that more, of that tonight. So let's go and do it. So step one is I always start with the market. It's got to be the right market. Otherwise, I'm just looking at a watch list, because if it's a red market, I'm not going to be jumping in and doing stuff. So I do like to start and kind of know what the market is. We did that on Tuesday. We have a pretty good idea, but I'm going to do it again. And here's a little score sheet if you want to use it. How is the VIX looking? How are the market internals looking? What does the index action look like? What are some sectors doing? I don't do sectors all the time, but I do kind of want to keep abreast of what's going on in the sectors. So I'll show you what I look at. And then you can decide what your assigned strategy is that you're assigning yourself. It's the market's flat, so I want to go kind of the balance point, or I want to be a little bit defensive because Nvidia's got numbers next week, or whatever. Okay, so we're going to go look at the market right now. So if I were looking at the market, and this is earlier today, I would say, we've got a long-term uptrend and a short-term downtrend. So those two to me are offset. The more important one is the short-term. So I'm not loving the short-term on QQQ. Okay, that's one or two dots right there you can look at, and it's below the 50. There's another dot. I don't like 2 out of 3 of those little dots that we're using to paint the picture here, or those brush strokes. Now, the S&P 500 looks a little better, doesn't it? It's right at the 50, maybe a little bit above it. It is still in an uptrend. It's not really in a downtrend. It's kind of more of a side trend. I like that. So I'm getting a feeling that the market is a little bit more than 50% toward the upside, let's say, right? Next one, let's talk about the Dow. Now this one's totally different because it's above the 50. It's just a few days off the all-time high, and this not even in a short-term downtrend. It's kind of flat to up. So this looks good. And then we'll go to the New York Stock Exchange. This one to me is my favorite one because it's the broadest index. And I look at it and it's above the 50, it's above the 21, it's above the 8, it's pushing an all-time high. Who knows? I mean, even with tariff news today, the stock market ended up doing pretty well. The volatility index, I do like to take an inventory of the VIX. The VIX looks like it's coming back to the mean there today with that decline. That means there's less panic in the market. The market's a little calmer, less volatility. Those kinds of things. So that looks pretty good. So overall, 5 charts, and I just painted a picture that I think looks not incredibly bullish, but pretty bullish, pretty good. Kind of, a nice orderly melt up, if you will. And so then I go into Market Smith and Market Surge, it's called now, and I look at the top industry groups. So here are the top industry groups. I'm not going to go that far into them, but you could see fiber optics is number 1, and it's been number 1 for a while. You can see computer and data storage. This was the number 1 group last year. It did incredibly well, and it's number 2 right now. And if you look at the charts on Western Digital, Seagate, Micron, they're just up and to the right, almost too much. So I'd be a little careful with those, actually. Mining, semiconductors, oil and drilling, energy, semiconductors, telecom, cables, machinery, electronic parts. So you can see there's kind of a mining and energy little bit here, and it's a lot of semiconductor stuff. So a lot of technology as well. Okay, so that makes me feel like I should be in those industry groups. They're the top tens, and they've pretty much been kind of holding their own for the last little while here, except for the semiconductors, which have really come a long way. So let's look at the bottom industry groups. The bottom industry groups out of 197. I think I mentioned this week, but computer software is getting annihilated. You can see for the year-to-date changes that computer software down 23%, down 32%. This is just since January 1st, down 21%. And if I showed you the top stock in this group, you'd be like, oh my God, I would never buy that. That is poo-poo. I don't want any poo-poo in my portfolio. So, you've got to know what the bottom stuff is doing. And this comes from just, going through this, and there's lots of tools out there to do it. I just happen to use the one that I pay for called Market Surge. Okay. So now you get an idea of what's going on with the sectors, and now we can make a decision on which way we think the market is going. The next one is you should have a watch list by now. You should always have a watch list. Maybe you have a watch list for a green market, a yellow market, and a red market. Maybe you have a watch list for things that are breaking out or things that are about to break out. You should have watch lists, and you should go through those charts every single day just to get the feel, and also to not feel like you're having FOMO, like you've got to get in today. You looked at it yesterday, it's not at the right spot on the chart, pass, go play golf, whatever, right? And so choose your stocks on your watch list. You might have a few watch lists that you use in a spreadsheet and rank them like this, whatever. I just gave you a sample of how you may want to look at that. Now, what I do, this is my watch list, and my watch list has lots of different stocks on it that I follow, that I like, and that some of my customers and clients and students follow, so that I know what they're doing as well. But not all of them are at the right spot on the chart. That's why I go through them every day. So I just go up, start an Apple, and I click through Apple, AMD, Amazon, ARKB, and I just go through, and that gives me a whole picture of what's going on in the market at a more granular level for me, because these are the ones that I want to get in. And if you'll notice, if you go all the way down to the bottom, there's a stock called GE, which I did happen to get in a couple weeks ago, and I want to add to my position. So we're going to analyze GE as if it's a brand new position or as if it's an add position. Totally up to you how you want to read it. But this is how I do it. I pick it from my watch list. Now I've got the right market, and I'm going to choose the right stock, and we're going to look at it. So the top stock on my watch list this week is GE Aerospace. It's got a blue dot on Market Surge, which means the relative strength is at an all-time high here on this chart. And it is now in a breakout. It's in that blue zone. It's a little hard to see on the weekly, but it's right there in that blue zone. It's 2% from the pivot in a week. So it is kind of in the buy zone, and I don't want to miss this. I only have 5% before I miss it, so I want to check it out. So then I zoom in a little bit to the daily, and now I can see, it's gapped up today. The volume ended up being pretty good for today. This stock to me is like almost textbook because it has great numbers. You could see from 298 to go to 850 next year, and all the other stuff. We talked about this stock the other day. So I like a stock like GE, and I bought some. I bought my first position. Now I'm going to buy my second position, and I want to buy all of my position before it gets to 5% away from my break-even point or my breakout point, my pivot. So that's how I look at it. Cool. So now I know the right market. I know the stock that I want to analyze. See how this isn't just like, hey, let's pick a stock that Kramer mentions and we'll sell calls against it. See how there's a little bit more science to it? And that's the way I think you get the odds in your favor. You just keep stacking 1% at a time, getting those odds in your favor. Okay. So now we want to kind of put together our trading plan. I will say trading plan until I'm blue in the face, but most people won't do it. I'm still not going to stop. I'm going to tell you, you got to have a trading plan for every stock that you're in, and it's got to account for every market. You need to buy, a target, and a sell stop or a circuit breaker, and you need to know what your strategy is. So I put this little thing together. My entry is going to be from 332 to 349. That's 0 to 5% from the buy point, the pivot. My target is 400. When it gets to 400, that's time for me to go, okay, Mark, that's where people start to take their profits. What's our strategy at 400? Until then, I'm going to use the rest of my trading plan. But what happens if I'm wrong? Because I'm going to be wrong. I'm just a guy. that reads charts. And, it's at 309 is where I want to get out. Or when it goes to break even, I want to adjust it, plus 5% from my average price. So as the stock goes up, I might raise my circuit breaker to break even, and then I might raise it again from 5% to the average price, down 5% from the average price as well. So what I'm trying to do is I'm trying to go green, right? If you've ever done a trade in the stock market, it feels really good when you click the mouse and all of a sudden you're positive, right? And then all of a sudden it goes up. You want to be green from the outset, and so you want to move your break-even point to the point where you can't lose money. So you want to keep moving your circuit breaker, I meant, to that point where now you put it at break-even. Okay. The strategy I'm going to use, because we're in the market that I just discussed, and I'm a little bit conservative, I could go rocket, but I'm going to go balance point. For you, I'm going to recommend Fortress probably, but I'm going to show you the different ideas and you can choose, okay? So we're going to look at balance point, and that means plus or minus one strike around the at the money level. And you're going to see on GE, we have choices, right? Because it's kind of right in the middle. And so in a red market, I'm going to go deep in the money, deep enough to make 1% of juice. So if the stock is trading at 340 or 330, I want to make $3.30 a week in juice. So I'm going to look for my juice column and go down to where I'm making $3.30 a week in juice. That's my goal. In a yellow market, I'm going to go Fortress minus a strike. Okay, go one strike deep or maybe two. In a red market, I'm going to go deep enough in the money to make 1% juice weekly, or I'll probably get out. Like this is a little fuzzy for me on deep in the money, but I'll have a circuit breaker and it'll kind of depend. But really, if I go deep enough to make 1% juice weekly, that's going to be several strikes deep, so I have some safety. So that's probably the rule I will stick with, and that's why I put it in the trading plan. Earnings, I'm going deep enough to protect from the implied move. Or I will go 7% deep in the money, because most stocks that I see, now I'll say this and in video go down 15%, but most stocks will go down 7%. At least have something that you're deep in the money. Basically go deep enough to protect the implied move down so that you don't get hammered when the street is giving you like where they think the stock is going to go. Other rules that I have, I'm going to defend my position when possible. It's not something we taught in the dare here. And I'm going to use the 75% guideline on the juice, also not something we talked about. But that's essentially my trading plan in a box. Entry, exit, target, red markets, yellow markets, green markets, circuit breakers, all those things are in there. And see how simple it is? It's not brain surgery, right? You just got to have an idea of what you do, and then you have to execute it, right? Don't be the person that has a trading plan and you never look at it. Look at it every day. All right. The fourth section of this is the option selection and final position. So now I know that I have the right stock and I'm looking at the juice. Which strategy am I going to use? And I already know which one I'm going to use, but I'm going to give you all different ones in case you decide that you want to go someplace different. So you can put together a little spreadsheet like this in Excel, but I'm like old school. I've been doing it this way for a long time. You see how I did it last night? That's how I do them all. So, to create another spreadsheet for myself, and that's just me, is more work for me. So I'd rather do it my way, but I'm giving you the spreadsheet kind of format in case you want to use it and kind of know what your strategies are. But here's how I do it. I go, all right, Mark, we're going to be the balance point and we're going to do the weeklies. So we're going to go to GE and see that it's trading at 339.23. And we're going to go down and we're going to go one strike price. Since the stock is at 339.23, it's almost at 340. So I'll probably just do the 340s because that, the balance point can go one strike either way for me, right? Remember that was on my trading plan. And I'm going to look at the weeklies. Now, my goal is to try to make 1 to 2% a week or 2 to 4% a month. And if I'm in that sweet spot, I feel that I'm being responsible. If all of a sudden my stock starts to pay 5 or 6% in a week or whatever, I know that it's a very risky proposition and I don't need to take that much risk. So I go over here and I say, all right, I can pick up $5.90 in juice. Remember, that's that extrinsic column at the 340s for a week. So on 100 shares, that's $590. On 1,000 shares, that's $5,900 a week that I bring in income. Now, If the stock goes up a little bit, I get to make that money. So let's look at the numbers. This will look familiar to you. I do the same thing every time. I put the stock price in here at 339.23. I do the short call at 590. The strike price is just at 340 and 1,000 shares and at 7 days. So my break even comes down to 333. So now the stock can go down, a couple of percent, 3%. And the juice is going to be 590. The percentage juice is going to be about 1.7% a week, and annualized it's 92. It's not outlandish, but it's not too small, and so I'm okay with that, right? So this one, if the stock stays the same, I make 5,900. If the stock goes up a little bit, I make 66.70 for the week, and then I just do it over and over again because I have a little tiny bit of upside, 70 something cents, 77 cents. So that's how I look at the balance point weekly. Okay? So the next one, let's say that I want to go to the Fortress and I want to be ultra safe because I don't know, this stock has really gone up and the Fed's going to be coming out with whatever, or Nvidia's coming out with whatever, or the tariff Supreme Court thing is coming out, whatever. Like maybe you're a little skittish. It's nothing wrong with being conservative. So let's say you want to use the Fortress Weekly. Same thing. 339.23, and now instead of going to the 340s, you go to the 330s. That gives you a bunch of cushion. How much cushion? Well, at the 330s, you're going to get about between 1180 and 1275 of cushion. That starts to become a bigger spread, right? Because it's a little bit less liquid and deeper in the money. But still pays 1%. It's 305 in juice. So I get 1% for a week. How many weeks are there in a year? 52. That's about 52% a year. That's very not bad. And I'm safe all the way down to 330. Actually, a little bit better. Let's look at the numbers. So we got a break even. I put all the numbers in there. I pick up about 12.20 because I split between the bid and the ask. And then that works out to be about $2.97 in juice-ish. Let's call it $3. So it's not quite 1% in a week. Now, my goal is to try to make 1% to 2% a week, but 9%, 0.9% is close enough. So if the stock stays the same, I make $29.70. If the stock goes up a little bit, I make $29.70. So I'm not getting any upside participation, but I'm getting a huge amount of downside protection. Stock has to go from 339 to 327 before I can even start to lose money. I like that, and I'm still getting 47% a year if I could do the same trade over and over again. And remember, the deeper you go in the money, the higher your delta, which means the higher percentage chance that you close in the money, meaning you make your maximum amount of profit, which is, in this case, $29.70 for the week. It's not as much as we were making before, but now I can sleep a little easier knowing that this stock has to really drop a lot, $12, $13 for me to start even losing money. I like that. So that's the Fortress Weekly. All right, maybe that's too conservative for you, or you want to look at some other things. And I think you should look at them and, try to figure out how, what works for you. So we got the Fortress Weekly, we did that. Fortress Monthly. So now instead of going out a week, we're going to go out a month. Oh, that's great, because that means we can go to the spa, we can play golf, we can go on a trip, we don't have to be looking at our phone all the time, and we shouldn't anyway. But now when I printed this, the stock went up a little bit more. So we're going to go to the Fortress Monthly here, and you can see there's my position there. But I've got the Fortress Monthly. We're going to go a strike in the money, basically, because it's at 340. We're going to go down to the 330s. Well, the 330s for the month are paying $867 a contract. You see that? So they pay you $867 and you're $330. You're $10 in the money now. So you end up getting between $18.15 and $19.50 because that's got some in the money amount, and it's got $867-ish worth of juice. Okay? And so let's take a look at how those numbers look. So here we are at 340.18. We pick up 1870 because we split this bid ask price 1815 by 1950. And we pick up, we go down to the 330s, 1,000 shares. It's 28 days roughly. And our basis now is 321. See how much more downside protection we got? Now the stock has to go from 340 to 321, but now we have a month to do it. But it could go up too. And if it goes up, that's great. If it goes up, I'll show you. We end up making $8,520 because it's already at its maximum price. We're going to collect all that juice. We're going to collect 1870, but the 852 is really our juice. What happened to that? Right there. That's what our income is. That's what we're going for. That's the rent when we have that. We rent out our stock to somebody, right? We end up collecting $852 a contract, and as long as it stays over 330, we make the entire 8520. Is this clicking? I hope it's clicking. All right, let's do one more. Let's say instead of this conservative stuff, Mark, you really think GE is going up. And look, I wouldn't be in it if I didn't think it was going up. So I could be doing the out of the money stuff for sure. And we could say, all right, let's enter this position with an out of the money rocket position. And we won't go too crazy. The stock's at 340. We'll go up here to the 360s. Okay? The 360s are trading between 410 and $5, so let's call it 440 or 450, something like that. And you can see the delta is 26. That means there's a 26% chance that stock is going to go over 360. Okay? If it doesn't go over 360, we don't have to worry about it because it never threatened the strike price. We could just do another covered call. But we don't get downside protection other than this $4.55 a share. So $455 a contract, got 10 contracts, pretty good, $4,500. But you also are hoping the stock goes up. You don't want the stock to just stay the same. You want to get a little of that capital appreciation. So what do the numbers look like? Well, here they are. You end up with a 335 break even. So you're not getting a lot of downside protection. You're shooting for the upside here. So if you happen to get this one right in a month, you make $4,400. If it doesn't move, or if it just, if it stays around 340.18. But if it goes up, you now make 24,000. Okay, and now the percentages is crazy if it goes up and you make $24,000 in a month, right? So you get to compare all of these against each other. Look at the annualized ROIs. Look at how much protection there is. Consider the fortress very much. Because if it does what it's supposed to do, I think I messed this up. But if it goes up, you get the gain. If it goes up, this is not the fortress month. This is the rocket. So sorry about that. This is the rocket. All right. So that's the deal. Like you want the stock to go up. You've got these 360s, and if the stock goes up 20, and you're gonna make another $20,000 on it plus the 4,400 you're getting in juice if the stock stays the same. So that should say rocket. Sorry about that. Okay. So now you're getting an idea like, okay, I've got a stock that I like. It's at the right spot on the chart. It's breaking out the markets. Everything's lined up. You've got the right ball coming over the plate. You're ready to take that home run swing or just get on base, right? And that's how you do it. So we've spent, a half an hour on one stock giving you the lay of the land on 4 different strategies. Right? And so hopefully you do think about things this way and you do see that, you can make $4,400, but if the stock happens to go up, you make $24,000 on the rocket. Or you can be in the money and have a higher certainty that the stock is not going to erode value in your account, but still collect income. You start to realize what kind of a trader you are. And the more trades you do and the more people that you talk to about it that get it, you're going to start kicking around some ideas that are going to be a lot higher level than, hey, let's just buy the stock and sell the call against it at a 20 delta out of the money like most people do. Okay? I don't want you to be most people. I want you to take a more scientific approach to this because you're stacking those probabilities. I want you to get those probabilities up to 77, 78% of you making money. And this is the formula to do it. So don't let greed drive your decisions. On that last slide, we did the rocket, and all of a sudden you can make $24,000 in a month by just going a couple strikes out of the money. Maybe that's the right one for you because you're willing to take the downside risk. Maybe. But I could tell you, you can get really rich making 1% to 2% a week. You don't need to make that huge amount of money. But nonetheless, that is a strategy, and it's a strategy for the right stock in the right market. And maybe GE is going to go up to 360, and you would make that in a month. Maybe. That's great. So don't let greed drive your decisions. Let the market and the stock tell you. So the market and the stock tell me that I should be in the balance point. So I'm not going to go, wow, that rocket looks really good and that stock is going to break out. So I'm going to get greedy and shoot for that. And then all of a sudden we have a market tank and you wish you'd have been a little bit safer. And have a trading plan for every stock that you do. I'll keep saying that and probably until my last dying breath, but have a trading plan for every stock that you trade. So here is a weekly decision tree. This shows you, and this is just a, you don't have to do it this way. You can do it all in one day, but you check out the market on Monday morning, takes you 10 minutes. On Tuesday and Wednesday, you look at your charts and your stocks, go through your watch list. I do it every day, but you don't have to. Thursday, you do your entries maybe, and then your ongoing management is 5 minutes a day. You check your stocks in the morning, maybe you check them in the afternoon. Make sure that everything's still within that area. Set your alerts if you have to make an adjustment or you have to get out of a stock because it hits your circuit breaker. Set an alert so that no matter where you are, your phone's going off and you can get out of that stock. So you can use that if you want. That's just something I put together that kind of shows, hey, you can really just spend a few minutes a week and do this, and this is also kind of systematic. Just do the same process every week, and then also on Saturday, that's a good day to sit down. The market's closed, realize how you did, analyze your trades. What would you do better next week? Do a post analysis, really important as well. So what separates consistent from inconsistent traders? Well, the system works because it's repeatable. So most people don't have a system, and most people don't have a trading plan. You do. You got the system now. All you got to do is do a little work and put together a trading plan. Market conditions are always going to be different. They change. Market could be great one day and bad the next day. You've got to be adaptable, but don't adapt every day. Like, don't just get yourself head faked into that. That's why I created the Genius market timing system, that it's a smoother system. Market conditions do change, but your process is going to be the same every week. And each day we've built upon this process for an hour, hour and a half every session. And so now you know how to do it. So most good traders follow the process. They don't try to be Nostradamus and predict. Inconsistent traders are guessing and they're trying to pick the bottoms and they're making non-process and systematic decisions. They're like, Palantir's a great company, or, Hims is a great company, it'll come back. And they just try to do things because they're on sale or because they emotionally get involved. Don't be that person. You have a system. They match the strategy to the conditions is what the professionals do. They wait for green lights. This is the hardest thing, guys, is to wait and wait and wait and wait for the setups. And I know you want to get into your stock. You're like, I can get in early. But wait for the right time. There are some spots on the chart that are early entries that are good too. But wait for them to appear for them. Don't try to force them. The market doesn't care what you think, right? You have to care what the market thinks. And then great traders manage actively. They're not just, we're going to buy this and forget it and we're going to check it out and the market's going to do what it does. These are options that expire and they decay and you have to give them some kind of management according to your rules. So that's essentially the system, right? We've spent 35, 40 minutes kind of going through it. But once you go through it a bunch of times, it's only going to take you 5 or 10 minutes to get into a stock. Maybe 5 minutes because you already know that that's the stock. Now you just have to choose what option you're going to do. And today, before I got here, since it is Friday, one of my mastermind people doesn't have a huge amount of money in the market. He's actually a really young guy. He's 33 years old. Shared this with me, and I thought, well, I'll slap it up for you guys tonight so you can see that it is possible. This is a guy. I'm not going to say his name because he hasn't told me I could, but this is what he does every week. And if you do this every week, you will become a more disciplined trader than you are right now. I guarantee it. Because this guy has built this little spreadsheet with these little pull downs and all these little cool things on the left side. Most of them are covered calls. He's doing in the money. He's got some synthetics, which we haven't gone over here. But you could see he got in today, and almost everything expires. Actually, everything expires next week. And so you can see he's got I don't need to go over it all of it for you, but he does weekly covered calls. And he's got more stocks than I think he should have. I need to have a chat with him, but he's doing great. He's gone from $6,700 a week just a couple of months ago. He's now making about $92.18 a week. So I thought I'd show that to you because, you invested in this program, not a huge amount of money, but I hope it's been worth it for you. But you can see that it's possible. And here's just a guy that happened to, send me his list today, and he's making $9,200 in a week. I think that's pretty darn good. And it's not a gigantic portfolio, it's just a few hundred thousand. And he's doing awesome, and I'm proud of him, and he is accountable to himself. And I hope you guys do the same thing. I hope you sit down and say, I'm taking this seriously as a business, because you do have to treat it as a business. And now you have a complete system. All you got to do is make some decisions every week. You got 3 different strategies within covered calls that I don't think anybody else is teaching. You've got a weekly ritual that works. You can run your Market Monday, check. You can check on your watch lists. You can pick your stock and where the breakout spots are. You can do some, do the calls at the different things. You have a lot of things that you didn't have 5 days ago. And if you did have them, I'm not saying you didn't know anything before you came in here, because if you did, maybe you can stack some nuances on top. I highly recommend that you join some kind of a community. So here comes the commercial. All right. The system is yours. Go out and use it. And if you want to go further with me, I have some ways to do it. I have lots of different courses, but the main one that I have is called the Elite Course. I'm very proud of it. I've worked on it for, I don't know, pretty much my whole life, but making videos for the last 6 or 7 years. And every time I learn something new, I can't wait to make a video about it and put it in there. So it becomes this gigantic course. It's 120 something video lessons. We go deep on lots of stuff. We go deep on sustaining the system, on protecting your account, on defending your position. We go deep on market timing. And I'm telling you, I have never seen anything like this out there. So if you want to really learn this, you've learned the platform, you learned the ideas, you've learned the system. Now it's time to become the identity of the trader that you want to be, or the investor that you want to be. And it's time to, put some decision making with it. So you're either a dabbler and you kind of dabble in different things, or you're an information seeker. Maybe you just like taking these dares and these challenges and getting information, and that's fine. Or maybe you're a decision maker that takes it seriously. And if you are, I'm pretty proud of the course that I have here for you. I'm not going to go too far into it. I just want to tell you, it's for people that want some structure. It's for people that want some repetitions. If you want the full blueprint, including synthetics, which give you some leverage, and which allow you to make things happen a little bit quicker. A lot of people call them the poor man covered call. I hate that name because it makes me think you're going to become poor. If you want to call it something, call it the rich man covered call. But it's for the people who want the full blueprint, because we teach other strategies and defensive strategies that we haven't been able to talk about this week. I just was showing you the potential this week. We teach people that are not fully confident, and this is a system that you will use for the rest of your life. The system is $2,997. I like to think you make that back in a pretty short period of time, depending on how big your account. You should have probably 50 grand minimum to play with. You can have less, but I'd feel more comfortable if you had more than 50. A couple hundred is great. And I'll deduct the cost of your $10,000 DARE enrollment if you want to buy this by tomorrow night, invest in yourself by tomorrow night. So that's the first offer. The second one, and see, I'm not a pressure guy. If you want it, if you want it, it's up to you. I know it can help you. All right. We are having an event. We just had a beautiful event in Clearwater, Florida on the beach, but now we're having an event in Arizona coming up in a couple of months in April 17th through 19th. It's a perfect time of year to join us in Arizona. And this is a more intimate event than our event in Clearwater. We had 120 something people there. This we're limiting to 60 people, and it's already starting to fill up. So if you want to join, love to have you there. It's called the Strategy Room because we're going to be going deep on strategies. So if you're brand new by the time you get there to covered calls, we're going to be doing a lot more strategies and strategizing and intimate things there because it's a smaller group, and I want to have it be higher quality for each person. So that's why we're limiting it. It's a private 3-day strategy intensive, April 17th through 19th. It's at the Crown Plaza just outside of Phoenix in Chandler. It looks really nice. It's a private invitation-only event designed for serious investors who want to tighten their execution, eliminate friction, and scale with confidence using the system you already know. We are, again, we're limiting it. And so once spots are filled, registration closes. But I think we're closing the early bird price, and Heather can correct me if I'm wrong, next week. But right now it's $15.97. The regular price is going to be $29.97. But, you know, this would be the opportunity if you want to join us and you want to meet other people, have a little bit of fun. The place looks gorgeous. And it's on a golf course. So if you want to come early, stay late, whatever, play a little golf, enjoy some Arizona weather after this crazy winter, that's great too. Okay, love to see you there. Love to see you in the Elite. If not, that's okay. I've really enjoyed being with you. I am a little bit early tonight, so if you do happen to have some questions, I will take a few as long as we're done by 8 o'clock. But anyway, let me give you the links to sign up. If you want to sign up for the Elite, sign up, you know, before tomorrow, tonight, if you want to do it after the call. But go to cashflowmachine.io/elite, and there's a couple of buttons. The green one says, I want to enroll. Click that one. Use this coupon, 10K Dare. 10K Dare will be the coupon you stick in at checkout, and that'll give you, you know, what you paid for the course. If you want to join us in Arizona, go to cashflowmachine.io/Arizona 2026. Make sure that's all in lowercase, because if you put the capital A in there, it won't come up. And so those are the two links that you want to talk that if you want to get involved, those are the ones that you can click on. Somebody else asked me if I could talk about the mastermind. I don't want to take everybody's time and talk about the mastermind. If you want to talk about it, it's my favorite thing, because you're immersed in this and you have a peer group that high fives you and understands what covered calls are. And we meet a couple times a week, and you have an accountability pod and a partner, and we have, you know, WhatsApp chat groups and all kinds of stuff. But I'm not going to spend much time on that. If you're interested in that, call Heather or contact Heather, schedule a call, see if you qualify. The minimum really is about a couple $100,000 to be in that of investable capital. That way I can feel good that if you're in that, you get your tuition at least back in a few weeks or months of juice. But with that, let me go and open this up to questions because I'm done with the slides. So I hope I ran through those and gave you guys enough time that if you want to ask some questions, I do have a few minutes. If not, we can have an early Friday night.
Cool. So Joe had the first comment. He said the juice was squozen. So just so you
All right,
know,
Joe.
he's talking
Joe
your
picking up
language.
the words.
Um, Jake had a question. When you were talking about your trading plan, you talked about the stop, and then he was asking, what do you mean by the plus 5% from the average price? He didn't quite understand that comment.
Okay, so and this goes in, there's a whole science of how you buy a stock. Generally, you don't just plunge in. I learned this from Jesse Livermore, greatest trader of all time. So Jesse Livermore would find the right spot on the chart, and then he wouldn't buy it all right then, because he could be wrong. We're wrong. We're traders. We're not always going to be right. Like, we got to admit that. And so when he found that right spot on the chart, he might buy half of his position there. And so that's what I've learned, is that at the breakout, the breakout point, the pivot, you pick up part of your position there. And then most people, what they do is if the stock goes down, they buy more. They average down. That's the wrong move. That's a rookie move, because you're capitalizing your losses. What you want to do is, if you buy it at 100, your buy point's going to be between 100 and 105. So if it starts to go up and makes you right, then you pyramid in. You add a little bit more to your position. Maybe you add another 25% to the position. And then if it goes up a little bit more, you add the final 25% to your position, as an example. So that buy zone is between 0 and 5% of the pivot. So that's, I think, what you were referring to. And then when the stock keeps going up, right? Let's say GE keeps going up, or this $100 example, now it goes to 110. Well, now I might move my stop loss from 7% deep at 93 to 100, so that if it goes back to 100, I still haven't lost any money, right? If you never lose any money on any trade, then, when you do hit the big one, you'll make a lot of money. So the idea is to take risk off the table as you can. And even when you're getting into the stock, take risk off and pyramid into the stock slowly. Don't plunge in and buy it all in one shot, even though I know you're going to want to. Hope that answered the question for Jake.
Cool. The other question he was asking, he says, does it make any sense to short, example, bear spreads and bull positions at the same time?
Oh, great question. Yeah, I have a whole course on that called the juice lever. You could do a covered call on the right side, and on the left side basically a covered put using synthetics. Yeah, it makes sense. It's a lot of work though, I can tell you. And when the market's melting up like this, it almost drags everything down for you because you can make money on the put side by selling covered puts, but as the stock is moving higher, that's a lot of management and in the money rolls on one side, and on the other side, you're constantly moving it a little bit higher. So yeah, you can do it. You just have to be ready to sit in front of your computer a lot more.
Next question from Harry. He says, you talk about only 3 to 4 stocks, but you also say only risk 2%.
Yeah, I mean, there's a lot of different ways to handle risk management. And I think I touched on this last night, and that is, I like to have just a couple of different stocks in a portfolio. So if you got a $100,000 portfolio, 1 or 2 stocks, not a huge amount of stocks. But most of the street does risk management, like don't risk more than 2% of your portfolio on any one position. In other words, if you're down 2%, you get out and you stop trading. Well, I don't really buy into that, but that's a philosophy that a lot of people put out. When I do covered calls, I believe we get the percentages in our favor, and I'd rather do fewer instances, fewer names, and just try to be really careful with them. So I know it's a little bit of there's so many ways to go about the market, and I know that I might put out a video about what a lot of people do on risk management. You've learned my risk management system, for the last 5 days, and that is, have a circuit breaker, no worse than 7%, maybe even the 821, and have few stocks and get the juice on them, be in the money. That's my risk management on it. Other people trade different ways, and they don't want to risk 2%, more than 2%. So, that's a very valid way to do it as well. So.
Great,
I don't
thank
have all
you.
the answers in one fell swoop. I teach a few different kinds of courses. So
Okay, so next question from Patrick. I know we're not talking about synthetics, and I have several synthetics going. What's a good spot to stop during the drop in price of the long? I understand if it's beyond the score of this challenge.
yeah, so synthetics are just a way of replacing your stock with an in the money call, and you can save a lot of money by doing that. And there's a whole science about how you roll synthetics and things like that. I like to keep my synthetics at 90 when I start, 80 to 90, and then after it starts dropping to 80, you might want to consider getting out and using that circuit breaker. Otherwise, you're going to get down into the 70s, and then you're not going to know where to sell your calls, and you're going to have delta flips and all kinds of problems. So don't let yourself get into that spot. Use your circuit breakers to get out when you got to get out.
Another follow-up question from James, who's asking about synthetic as well. He's in a synthetic position. It doesn't seem that one should do a fortress or sell the covered call deep in the money, correct? You
Nope.
kind of want to do the rocket because you don't want to be called away,
Yeah,
right?
we can debate that. I just had a conversation with one of the guys in my mastermind group, and he was asking me about his accountability partner, and he says, "Hey, I'm new, and my accountability partner is doing a synthetic and trading really deep in the money." And he goes, "Is that wrong?" And I go, "Why would it be wrong?" And he goes, "Well, if the stock goes up, you're gonna lose money." I go, "Yeah, but and sorry everybody that you don't understand if you don't know what synthetics are, but as the stock goes up, the delta also goes up and the juice also goes up." And I said, "How did he do last year?" And he said, "Oh, he made 40%." He was deep in the money on every single trade, really deep, and they were all synthetics, and he made 40%. So I don't need to convince. You can do the rocket, but you have no protection on the downside to answer the prior question of when your stock goes down. You'd rather be deep in the money on that to protect on the downside if you could. So.
Next question from Boyce. Is there any advantage to using more than one strategy on the same stock?
Um, I don't know about more than one strategy, but you can use different strikes. So a lot of people like to layer their strikes, and like on GE, for example, I had the 330s. I still have the 330s, and now the stock is at 340. So the next set of calls I might do is 340s. And then the 330s are really deep and giving me all kinds of cushion, and the 340s are giving me all kinds of juice. And then if it goes to 350, I might do the 350s or the 360s. So yeah, you can layer things like that. I don't know if it's different strategies, but it could shift strategies because the market might give you a different approach. All of a sudden, we go into a rocket type of market. You might want to be out of the money. Yeah, for sure. Again, I'm trying to give you the down the middle stuff, but there's all kinds of other stuff on either side of that. But yeah.
Next question from Jason. Question on deep in the money covered calls. Is the strategy to let the covered call expire, roll, percentage gain, etc.?
So for me, it takes so much effort to get into a stock, so much analysis that once I get in, I want to stay in because I want to have one of those stocks that I showed you on Monday that goes up forever, and I'm just squeezing the juice all the way up for forever. So for me, you can get out of a stock when it expires. You can let it go and not roll it and let it get assigned and start over on Monday. It's just I go back to what Steve Jobs and Mark Zuckerberg do, right? Well, Zuckerberg not so much anymore, but Steve Jobs always wore the same thing every day. It was like jeans and a t-shirt every single day because he didn't want to make decisions and take away his brain power for when he went to work. So decision fatigue is a real thing. So if you get taken out of a stock on Friday, now on Monday, what if the stock goes up? Are you going to go, oh, now it's way higher and now I'm going to be chasing it? So, or if it goes down, are you going to be, well, now it's down. I mean, like it's weak now. Do I want to buy it? Like you have all this new decision fatigue. If you just discipline yourself to roll it every Thursday or Friday or whenever it's got no juice left in it or very little bit of juice left, and you discipline yourself to that, that's the only decision you have to make. You're going to be in the stock for whatever. And then you might have to make a decision to defend your position on the way down. But it's not like, oh, what stock do I get into on Monday morning? Because now you got to go back through your whole watch list and decide if it's in the right spot on the chart.
Cool, thanks for that. Question from Rohit. For in the money only, how do you think through selling weeklies that are slightly in the money in comparison to selling monthlies where you can sell much deeper in the money? One offers more premium, though more frequent trades, while the other offers more protection because you can go deeper if you go further out monthlies.
That's a question that would depend on the market, the stock, where it is at on the breakout, spot. Like at the breakout spot in general, if I have a green market, I don't want to be that deep in the market, in the money. But if the market's kind of flattish, I want to be kind of near the balance point, or maybe one or two strikes. And if I go out a month, I get all kinds of protection to the downside. But I have a bent toward weekly. I just do. So I'm always looking at weeklies or maybe even bi-weeklies. I'm now looking at some monthlies, but I like weeklies because if you look at the weeklies, and maybe you've figured this out from the weekly, but if you get $8 a week, that's $32 a month. But if you go out to the monthlies, they might only pay $24 in juice. So you get less juice per week by going farther out, but you get at least $24 instead of 8 to cushion your downside. Again, they're options, so there's no real rule, Rohit.
So Larry has a question here. What do you use as your most common circuit breaker to exit? Chart technicals, percentage decline, others?
I use the 821 crossover negative to get out. And and if I'm so inclined and there's a high volume candle that closes below the 8-day exponential moving average, the EMA, I might get out then, even earlier. There's just no set in stone rule that you have to wait for the 821 to cross because it is an 8-day lag, right? I mean, it might move down after after the initial part of the move. So if it closes below the 8, I'm looking at it and go, wow, that might be time to get out, especially if it's a high volume candle. For me, and I'm different than you guys. I've been doing this for 45 years, so I'm going to be different. My trading plan might be totally different than Mike's or Rohit's or Jake's. It's always something different. Go ahead.
Thank you. Next question's from Rob. If you're in a leap, PMCC, and the stock continues climbing, do you ever roll the leap up for a credit to take risk off the table?
Yeah, I do some profit harvesting in that case. Sure. because then you can move to a different delta and basically start the trade, move it out, do whatever, harvest that profit. Absolutely, that's certainly a consideration.
Question here from Jason. Question for deep in the money covered calls. Is the strategy to let the covered calls expire, roll, percentage gain, etc.? Did we cover this or did I?
Yeah, we just kind of covered it. Yeah.
Okay, sorry, because I'm trying to go through the questions to make sure I'm getting everybody. So we did that one already. I think I have one new question here. Mike Kemp. Hey, Mike Kemp. So Mike, oh, he's offering to do a little testimonial if you want. Since Mike's a good elite client of ours, I'm not sure if that's something you want to do, Mark, but Mike's offering if you want to do that.
Yeah, if you want to say a couple words, Mike, always good to see you. You always have the best backdrops.
Okay.
Thanks. I'm wishing I was in Arizona.
I hear you.
Just a quick, I'm not a sales guy or anything like that. I just want to tell you guys my experience with using Mark's system. Little background. I work a day job, work a lot. Last weekend alone, I worked 45 hours with a hour and a half power nap. Um, so meaning
Wow.
that my time is very limited. I took Mark's system because I'm, getting ready to retire, and I took the elite course and the platinum course. I've been to the Tampa event and a couple of the other events, and I can't say enough about my experience with Mark and everyone you meet at those events and things like that. So, um, I started in 2023. All I can do is cover calls because that's all my 401k will let me do. Didn't really start doing anything until July of 2023. Just kind of testing the waters. And that first year, I still made about 60,000 off. I started with $700,000. The next year, I felt a lot more confident, and I took that account. I made 280,000 that year, making significantly more than I make in my day job.
Wow.
And like I said, I only do about an hour a week using the system. And then last year I made 219,000.
I didn't know
So
that,
still a
Mike.
good year. Yeah. Beating what I make at my day job. I'm about a year and a half away from retirement now. And I'm pretty confident I can retire because of using the system. This year, I'm not going to lie. This year, I'm struggling. Not anything terrible. Just because I started to get a little more laxed in my discipline. And that's why I actually signed up to take this, is just to get a quick refresher to kind of get back into the discipline and following the rules. So that's my
I would.
experience using Mark's system, and it works fantastic.
Thanks, Mike. I actually was wondering why you signed up for this. I'm like, this guy could teach this stuff. And Mike does actually on Sundays. He has a Discord group that he leads through this philosophy, and he's been doing it for a few years now. So I always appreciate that. I'm really happy to hear your numbers. I never heard your numbers. I just knew you were doing well, and congratulations. That's great. Anyway, good to see you again. Thanks for speaking up.
Thanks. Yeah, and if you guys do sign up for one of his other courses, the Elite or the uh, uh, Arizona meetup, maybe Mark or Heather could share the link to the Discord, and then you guys can jump in there if you feel like it.
Yeah, it's a little more advanced because you guys talk about a lot of advanced stuff. So make
Yep,
sure you're advanced if you're going to go there. But yeah, happy to share if, yeah, cool. Thanks, Mike.
no problem.
Great to see you. All right, we got 1 minute. I could do one more question if you have one at the ready. If not, I'll say goodnight.
The last follow-up question from Jake, he's like, let me just grab it. So he says, so if you don't want the stock to be called away, but it's in the money, do you just buy the option back and sell next week? Covered call at a higher level?
Yes.
Awesome. That was an easy
Yes.
answer. Last question. That was it.
Great. Todd has sent a link that says, in case you want to share with the group, it's a great resource. He's got a resource here for investors.com. Maybe we'll figure out a way to put that in the email for you guys, because it's a long link, and I don't know if we can do it in here. But anyway, let me thank you for being here. Many of you came the whole time, which I'm very, very impressed with, because most people sign up for something, especially when it's not a huge amount of money, and then they drop off, especially if it's a Friday night and it's party time. But you guys have stuck it out, and I really appreciate that, because I hope you see how much I put in it, because I want to help as many people as possible. I hope I see you down the road. If I don't, good luck with this. Just be diligent, have a trading plan, have a circuit breaker, apply it, and be diligent with it. If I do see you down the road, I can't wait to meet you face to face. Thank you so much for your time. Go out and make $10,000 and make me proud. And by the way, I'll put a video out real quick, and you can comment in that video. And it'll be just for us, but it'll be a video, like a thing that you can tell us your wins in the comments, and that way we can kind of have our own little group on a YouTube video comment chat. How about that? All right, everybody, thank you so much. And VIPs, I'll see you on the other link in a couple minutes. Have a great weekend, everybody, and thanks again.